Welcome back to New Money. This evening we're discussing investments. My guest is Henry Biddlecombe, and if you'd like to email us, you can send your inquiries to info@anchorcapital.co.za or info@bhca.co.za. Let's just go back to the AI story. All this money's been spent, as you say. You spoke about a company like Meta, 30 billion, now nothing on their balance sheet. I mean, surely this is not going to reflect positively, and certainly there's going to be, whilst they've earned a lot of interest with interest rates being higher, how is this going to affect it? And I believe Goldman put out a report, and you'd just like to comment on it.
Yeah, so Goldman tried to put some numbers to it the other day. And every business ultimately boils down to unit economics. So what does an incremental unit cost you to produce as a business, and what do you make out of it? And phenomenally, and perhaps unsurprisingly, the unit economics of AI at the moment are negative. So in other words, for every additional unit that a company like OpenAI, for example, sell, they actually burn cash. So you're spending a tremendous amount of money on a cash negative business. And that does not bode well for the businesses that are putting all of this cash into the ground.
Well, isn't that a bit concerning now in the next few weeks, the reporting and all this cash having been spent and the comment you make about burning cash?
Yeah, well, of course it is. I mean, there's certain beneficiaries of that spend, such as NVIDIA, TSMC, and all the guys that are producing the chips that are being sold. But as for the companies that are spending all of this money, the so-called hyperscalers, the market will eventually look for a return on that cash. And I don't think you're going to see it for a while. Simultaneously, those same companies' stocks have re-rated upward. If you look at the Mag 7, they're all trading on forward multiples of between 25 and 30 times the next year's earnings. In my opinion, those multiples are not justified, given the negative incremental return on all of this capex.
Henry, we've had some tough Octobers in the years, but predominantly the last quarter of the year is pretty good quarter. How are you reading this going to from end of December, early into January? How do you see markets, your view on markets between now and December?
Always easy questions for me, hey, Bryan.
Well, I'll make you, Henry, you've got a crystal ball, so it's easy.
Oh, yeah.
You just turn to your left, you look at the ball, and there you are, and you get your answers.
So look, it's a seasonally positive period for markets. That's a fact. But also, if we look at valuations, they're historically high. The kind of economic geopolitical tension around the world at the moment is abnormally high. You've got a real wild card as a president in the US. Trump can come up with any number of very aggressive negotiating tactics when approaching countries like China. So I wouldn't bet on seasonal positivity now. I think the market's actually quite vulnerable where we sit.
Okay, well, let's go into some emails now. Jane in Rondebosch says, I hope you can help. What is Ferguson's law? Well, I also don't know what Ferguson's law. And many commentators are recommending that 15 to 20% of one's investments be allocated to gold. I would appreciate your perspective on this amount. Henry, we've had an enormous run on gold, over 4,000. So maybe you can answer the second question. Do you still think gold, are you in agreement, 15 to 20% of one's portfolio going into gold?
It's such a hindsight trade. It's so obvious in hindsight where in the midst of COVID, the US government printed, 40% of the dollars that are now in existence in the space of 2 or 3 years. We should have all bought gold then. We should have seen it coming. The currency was obviously going to be debased. And gold is a natural store of value in that scenario. I think that trade's played out now. Like you, Bryan, I think chasing it at $4,000 an ounce is probably a little bit precarious. So I'd be loath to chase it here. And certainly a 20% allocation in one's portfolio feels rich, so I wouldn't do that.
Yeah. Henry, also I did some calculations when you talk about the increase in gold. When the rand was 1840 and the gold price was 3,000, the gold price would be at 4,000. Now, at the new rand price, the gold's about $3,600. So the strong rand has had an impact on it. And then what about Ferguson's law? Do you know what Ferguson's law is?
Yeah, I do. So it's a bit of a rule of thumb, which says that when a country spends more on servicing its debt than it spends on its defense. That kind of marks the beginning of the decline of that country and its currency. And interestingly, the US has reached that point now. And that probably begs quite an important question for investors, actually. What is the future of America, the future of the dollar, and the future of the credit worthiness of that government and the state of that country's finances? It's not as obvious as it was once. Debt as a percentage of GDP has reached a very high number, around 150%, I think. And funnily enough, and as funny and as strange as it sounds, you might start to see the US to behave more like an emerging market than a developed market now, where your nominal growth is higher for longer, but so is your inflation, and your currency will follow suit. So you're probably looking, if I were to speculate, at a protracted period of dollar weakness.
So you actually, are you seeing the Rand break 17?
Yes.
And 16?
Possibly. You know, I've told you this for a while,
yeah.
And some people might think I'm a nutcase, but you can quite easily justify an exchange rate of 14 Rand 50 to the dollar today.
Phew. Okay, well, let me get on, let's rather get on to Martin's email, because as everyone must understand, that's your view. Many people have a similar view, but you've always been a little bit more bullish in that way. But Martin Saxwell says, I'm both an importer and an offshore investor, and I'm conflicted about the Rand's performance, particularly its recent strength against the dollar, pound, and euro. I need to make a decision regarding A, payment for goods, and B, transferring additional funds for offshore. I would appreciate your comments. So first, he's an importer. Does he wait, or does he pay?
And I've been in that trade as well. If you're an importer, you need to cover your liabilities as soon as they arise.
Yeah.
They're all short-term liabilities and invoices that you need to pay.
Yeah.
And no one can predict what the currency is going to do 30 to 90 days out. So when you get the invoice, convert the money and pay it.
And now he's a bit conflicted because he said, I like the look of my portfolio, because I read this whole email. He said, I like the look of my portfolio when the Rand is weakening because my dollars are actually giving me a lot more Rands. And now taking money offshore?
Yeah, look, do yourself a favor, zoom out and look at your portfolio's performance over a longer period of time just to stay sane. If we go back to 2010, if you took your money out and you invested in the US market, you've done well in dollars and you've done very well in Rands, so relax. Will we go through a period of a strengthening Rand now? Most probably. Will emerging markets perform better than developed markets now? Probably. So why don't you make a tactical trade? Okay, if you've got 80% in the US market and 20% in South Africa, take that down to 70 and put another 10% into the South African market. I don't think that's a bad tactical trade right now. But over the next 10 years, do I still think that you should be biased towards the developed market and to the US? Yeah, absolutely.
So Henry, when you talk about buying the South African market, we've had gold, we've had PGMs, we've had NASTA and Process. Is there other places you can buy in the South African market? Yeah,
of course. South African banks last week were looking great. And they've actually bounced since Friday and Monday, so we've been very long there. And if you take SA Inc. out of the market, so leave gold, plats, and Naspers behind, South African's looking like a reasonable place to invest at the moment from a valuation perspective.
Okay. Then Ruben in Bantry Bay says, I understand that I can book a forward exchange contract to hedge against potential market losses. And he asks, what is your view on this approach?
Yeah, you can do that. Those are typically shorter term instruments that you would use. For
How does that work, Henry? You're taking a hedge?
Yeah, that's exactly right. So you're agreeing to pay a certain rate at a certain date in the near term future. But again, I would always recommend using those as a hedge and not a speculative instrument. So if you've got a liability that's denominated in dollars, use an FEC to neutralize that currency exposure. Don't go and speculate.
Okay. Harry in Richmond says, what is your view on the possibility of Citus impacting on my offshore shares? Are you aware of what's going on with Citus, Henry?
I'm not sure what exactly he's referring to. I mean, Citus has always been an issue.
Yeah. Look, I think Citus has become a much bigger issue. certainly with Americans and the UK and European, particularly France, looking to collect taxes. CITES is an issue that if you die, you're going to pay tax on the situation of those assets. CITES is definitely an issue. We're looking at it very strongly. I will be dealing with it in a few weeks' time when I've done full evaluation on it. Neville in Brighton says, why is our Reserve Bank reluctant to cut interest rates? The latest figures show that over the past 12 months, 57 billion has been withdrawn from pension funds under the two-pot system, with 80% of individuals drawing more than once. Given that most working South Africans have both a home loan and a car finance, this clearly highlights how many are struggling just to put bread on the table. Henry, but why do we not reduce interest rates?
Yeah, Bryan, I'm with you
You're
here.
with
I
me.
think we need to cut, and
Yeah.
I think we can cut. I'm not sure why we aren't cutting. The Reserve Bank's always pointed out that our economy is very vulnerable to currency-driven inflationary shocks, and on that basis, their first priority is to defend the currency through a higher interest rate, which I appreciate, okay? But is there headroom to cut? Now, more than enough. And the economy is crying out for it. So I'm with you. I think they should have cut. I think they must.
Yeah, I agree with you, because it just goes to show the only people who got members of pension funds are those that are working, and they can put bread on the table, eggs and milk, but they need money, and they've been borrowing. It's a lot of money, 57 billion. Well, if markets do decline and you have a long-term investment horizon, there's little to worry about beyond the emotional impact. Stocks may be overpriced, but attempting to time the market can backfire. Revenue authorities may classify you as a trader rather than investor. Historically, markets tend to perform better in the final quarter of the year, although there have been exceptions, with October not always being strong. In summary, if your goal is long-term growth, stay invested is usually the best approach. If your strategy has shifted and you now require income, it's time to reassess your needs. Most foreign investors, however, are not pursuing a blended strategy of both income and growth. It's important to remember that success in investing comes not from market timing, but from time in the market. Henry, thank you for joining me this evening. It's important to note that our program tonight is to provide information and should not be construed as advice. Next week's program, we'll be dealing once again with retirement and financial planning. And if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.